Hello everyone, welcome to Dr. Rajkumar's Learning app. In this session, we are going to discuss about the banking system in India. Okay, how the banking system got emerged and how it got evolved. We discussed in the last chapter related to the history of banking system in India. Okay, so now we will see about what are the functionaries. First one is money market. In this money market, borrowing as well as lending of funds take up a place up to 1 year. First time they introduced about the borrowing and lending money for the interest in the banking system. It is issued for short-term credit. It includes Reserve Bank of India, commercial banks, cooperative banks, as well as regional banks, some NBFCs. NBFC means non-banking financial companies. They started providing money for the interest as a loan for the short time period was exactly started, which is popularly known as money market. Scheduled banks. Okay, bank, those are listed in the second schedule of RBI Act in the year of 1934. All those banks were popularly known as scheduled banks because scheduled banks eligible for obtaining loans from Reserve Bank of India on bank rate. Okay, so why the scheduled bank loan is most popular? Because the bank rate is fixed by the RBI and also interest rate will be less. Non-scheduled banks means those banks are not listed in the second schedule of RBI Act 1934. Generally not eligible for obtaining loans from the RBI. Okay, keep CRR. Okay, with itself now with RBI. Cash reserve ratio. CRR means cash reserve ratio. Okay, next one is commercial banks. It is divided into two parts. The commercial banks divided into two parts, public sector banks as well as private sector banks. All these banks were regulated under Banking Regulation Act of 1949. Okay, they can accept deposits, can provide loans and other financial service to earn the profit. Those kind of banks were popularly known as commercial banks. Public sector banks. In these banks, most of the shares, more than 50% of the share are held by the government itself. So that we used to call it as public sector banks. Currently in India, there are 21 public sector banks after the merger of State Bank of India with their associate banks and Bharatiya Mahila Bank. So the number of public sector banks in India total in number 21. The nationalization of banks also was done by the government into two stages that we know. And what is the objective? The objective is reducing the private monopolies because private banking like dominating the loan area and social welfare, and also expansion of banking facilities to the common people of India and focus on private priority sector lending. So private sector banks, majority of the share not held by the government, it is held by the private hand only. These banks consist of both Indian banks as well as the foreign banks. So foreign banks came to India and they started establish their banks. Such example we can say HSBC, HDFC. Okay, these are all the foreign banks. The private banks which were set up before 1990 liberation of the economy are categorized as the old bank. After 1991, whatever the bank came into existence were popularly known as new banks. So private banks which were set up 1990 are categorized under new banks. Local area banks. The private banks also allowed to operate in the limited area called local area banks, registered under the Companies Act of 1956. The minimum capital which is required for these banks to have around rupees 5 crore in the Indian currency. About the regional rural banks. This was established under the act name called 1976, RRB Act name called 1976. The regional rural banks were set up by the public sector banks. Public sector banks started establishing the other branch which is known as regional rural banks. The objective of this, they wanted to increase the credit flow in the rural areas. After Kelkar Committee, okay, Kelkar Committee recommendation in April 1987, no new RRB have been opened. So the reason behind not opening the regional rural bank after 1987, the recommendation given by Kelkar Committee. Next one is cooperative banks. Establish the aim of funding the agriculture and cottage industries, especially in the country. Can perform both deposits as well as lending activities. They can deposit the money as well as they can lend the money for the interest as well. Such example we can say NABARD, National Bank for Agriculture and Rural Development, is the apex body of the complete cooperative sector in India. National income. What is national income? Some core concepts. Just know the abbreviation, that is fair enough. Other than that, I'm just giving you the information related to the particular topic. National income is usually defined as the total value of all final goods and services that is producing in a country for a particular time period. Generally, we used to calculate 1 year. In 1 year time of period, whatever the goods and services that is produced in a particular country, that is known as national income. To measure this national income, we have three important bases, that is GDP, gross domestic product, GNP, gross national product, NNP, net national product. Just know the abbreviation of the term, that's fair enough. So GDP means it's a total value of all final goods and services produced within the geographical boundary of the country during particular period, that is 1 year. GNP means it is defined as the total value of the final goods and service produced by Indians in India as well as abroad during the particular period, which is known as GNP, gross national product. Here it is related to the complete goods and service produced. Here final goods and service produced by Indians and Indians living in abroad, those value calculated under the GNP. Net national product, it is calculated by deducting the depreciation from gross national product, that is GNP. So NNP, GNP minus depreciation. RBI, about RBI, a few information. RBI was established in April 1935 as per Reserve Bank of India 1934 on the recommendation of Hilton Young Commission. So Hilton Young was the chairman of that particular commission. Based on his recommendation only, RBI was established. Central Bank of India was nationalized in the year of 1949 and central office initial was established in Calcutta, later moved to Mumbai in 1937, which means headquarters. Headquarters of RBI, earlier it was in the Calcutta region. Later on, the permanent place for the RBI was transferred to Mumbai. Okay. Official directors, one governor will be there, not more than 4 deputy governors. Currently following the person or on the following post: Governor of RBI Shaktikant Das and Deputy Governor M.K. Jain, Shri Vishwanathan, Dr. Viral V. Acharya, Shri B.P. Kanungo. These are all the 4 deputy governors of RBI and 1 governor, Mr. Shaktikant Das. What is mean by monetary policy? This policy which was made by the Reserve Bank of India to control the money supply in the country. Okay, because money supply is very important for any nation in terms of the economy activity. So to control the money supply in a particular country's economy, this monetary policy was regulated by the Reserve Bank of India. MPC, Monetary Policy Committee. This committee of India, of the Reserve Bank of India, that is responsible for fixing the benchmark interest rate. Okay, whatever the money market happening in the banking, so for that purpose, a separate interest rate will be fixed. That interest rate fixed by the committee name called MPC, Monetary Policy Committee. Section 45 is a B of the amended RBI Act 1934, which providing empowering 6 members Monetary Policy Committee to be constituted by the central government to determine the interest rate that required to achieve the inflation target. So based on the Act, okay, Amendment RBI Act of 1934, Section 45 ZB is giving the provisions related to the 6-member Monetary Policy Committee. Okay, the MPC is required to meet at least 4 times in a year. They will meet 4 times in a year. 6-member MPC is headed by the Governor of RBI, Shaktikant Das. So others few concepts here. I'll give you the exact definition of the concepts and you need to know about the abbreviation. That's fair enough. OMO, that is open market, open market operations. This method refers to buy and sells of securities, bills and bonds of the government by RBI. Okay, in the open market, to expand or contract the amount of money in the banking system. Okay, securities in the bank as well as bond can be purchased through the open market operation in all banks, which is known as OMO. Liquidity adjustment facility, LAF, is the greatest tool used by RBI to control the short term money supply. Okay, short term money supply, it has two important rate, which is known as repo rate and reverse repo rate. Okay, so liquidity means cash flow. Adjustment facility can be done through the two important rates popularly known as repo rate as well as reverse repo rate. Repo rate means the interest rate at which the Reserve Bank provides loans to the commercial banks by mortgaging their dated government securities and treasury bills. If any commercial banks wanted to get a loan from RBI means they need to give their securities. So, government securities and treasury bills, based on that they'll get a loan from RBI. That particular rate was fixed under repo rate. Reverse repo rate means the interest rate at which Reserve Bank borrow from the commercial banks by mortgaging its dated government securities and treasury bill. So, the interest rate at which RBI itself borrows from some commercial bank by mortgaging their securities, okay, and the treasury bills, which is known as reverse repo rate. The rate which fixed, interest rate which fixed by RBI while providing loan to the commercial banks, which is known as repo rate. RBI is getting loan from the commercial banks, that security rate which is known as reverse repo rate. Next one is MSF, marginal standing facility. It is a loan facility for the banks to borrow from the Reserve Bank of India in an emergency with a interbank liquidity. If interbank liquidity dries completely dries up, then they can get loan from the RBI, which is known as marginal standing facility. Next, reserve ratio comes under two category again, SLR, that is statutory liquidity ratio, CRRR, cash reserve ratio. All commercial banks in the country required to keep a given percentage of their demand and time deposits, that is net demand and time liabilities, okay, as liquid assets in their vault itself. So they need to have some amount of money as a deposit, which is known as statutory liquidity ratio of the banks. Cash reserve ratio. The cash reserve ratio is the amount of funds that the banks are bound to keep with the Reserve Bank of India as a certain percentage of their net demand and time liabilities. So bank cannot lend it to anyone. Bank earns no interest rate or profit on this. So they need to have some cash reserve. They are supposed to not lend that particular money to anyone, and in that money they should not get any kind of income. It should be there with the bank itself, which is popularly known as cash reserve ratio. Okay, here know the definition as the basic information, but you need to understand, you should focus only on the abbreviation. That's fair enough. For example, CRR means cash reserve ratio, like that. So bank rate, what is bank rate here? The bank rate is the rate which fixed by the RBI. Rediscount bills of exchange and government security held by the commercial banks. It is also known as discount rate. Okay, bank rate also known as discount rate. Next one is bill of exchange. It's a financial document that assures payment of money by the purchaser to the seller for goods purchased. That is called bill of exchange. Difference between repo rate and bank rate. Repo rate is a short-term measure. On the other hand, bank rate is the long-term measure. Okay, this bank rate is to be in the long term, but repo rate is the short term. It may vary from one time to another time. Now bi-monthly, that is coming as a bi-monthly, 2 months once this monetary policy was released by the RBI. Okay, so based on this we will discuss few questions, and here only focus on the static part. Don't worry about the conceptual explanation. Just know the definition and start focusing only on the abbreviation of all the forms. So first one is, which commission recommended the formation of Reserve Bank of India? You know that Hilton-Young Commission. Hilton-Young Commission is the one recommended the formation of RBI. So who regulates monetary policy in India? Reserve Bank of India only regulating the monetary policy. The largest and oldest bank which is still existence in India, that is State Bank of India. Okay, so practice more number of questions, and in this area you just know what kind of banking system that we are following and how it is like executed by the RBI, and also focus on abbreviations. That's fair enough for this chapter. Okay, all the best. We'll see you in the next session.